A genius idea with a fatal flaw. It began as a breakthrough so elegant that experts hailed it as the future. A strategy built on logic, precision, and mathematical beauty. So perfect that it seemed immune to failure. Until the moment it wasn't. This story matters now because nearly every modern investment tool is built on models. Formulas designed to simplify a chaotic world. We trust them. We follow them. We forget they're only as strong as the assumptions beneath them. And to understand the hidden danger in that trust, we need to revisit the day when a perfect strategy exposed a flaw no one wanted to see. It started with two brilliant minds who believed they had solved the puzzle of market behavior. Their model didn't chase emotion. It didn't fear volatility. It identified mispriced assets and explored the gap with quiet, disciplined trades. The returns were steady, predictable, almost serene. Investors lined up to join. Billion-dollar funds poured in. The strategy grew from an academic idea into a financial powerhouse. At first, everything worked exactly as expected. The model identified small inefficiencies, tiny cracks in market pricing, and profit followed with remarkable consistency. It felt like alchemy, turning discrepancies into gold. Report after report confirmed the same message. Low risk, steady returns, near perfect stability. The creators became legends, hailed as architects of a new financial era. But beneath the triumph, pressure began to build. The model needed scale to thrive, and scale drew attention. Other funds copied the strategy, crowding the same trades. The opportunities shrank, margins thinned. To keep returns strong, leverage increased. Borrowed money amplified every position, multiplying gains and dangers. The early reveal appeared when market conditions shifted ever so slightly. A sudden spike in volatility, a political shock, a currency ripple. Nothing catastrophic, but enough to wobble the assumptions the model depended on. Trades that should have been independent began to move in the same direction. Correlations tightened, spreads widened. The strategy didn't break. Not yet, but the signals were unmistakable. The system that once felt invincible was developing cracks, and the fatal flaw hidden inside the genius idea had just begun to surface. The pressure intensified as the market drifted further from the model's expectations. Small deviations that once corrected themselves now lingered, stretching the assumptions thin. The creators assured investors that the turbulence was temporary, anomalies that would soon revert. After all, the model had weathered storms before, but this time, something deeper was at play. The reveal grew clearer when liquidity began to dry up in the exact assets the strategy relied on. A handful of large players shifted their positions, creating ripples that spread across markets the model assumed would remain independent. Spreads widened. Arbitrage gaps closed more slowly. Positions that were supposed to behave differently started moving in lockstep. The model's elegant logic depended on relationships that were now bending under stress. Leverage magnified every wobble. A small loss didn't stay small. It grew. Margin calls loomed. The fund had to sell positions to stay afloat, but selling created more pressure, pushing prices further away from the model's predictions. The creators watched the screens with growing concern. Their formula wasn't broken. It was overwhelmed. The market wasn't behaving irrationally. It was simply reacting to forces the model hadn't been built to handle. Meanwhile, copycat funds faced the same problem. Many had borrowed heavily to chase the same trades. When the first fund began to unwind, others followed, not by choice but by necessity. A synchronized rush for the exits formed, draining liquidity and amplifying volatility. What began as a mild disturbance now spiraled into an early conflict that shook the foundations of the strategy. Traders on the outside noticed a distortion. Prices shifted in ways that defied historical patterns. Assets that rarely moved together now swung in unison. Analysts speculated about hidden stress in the system. Some pointed to geopolitics. Others blamed central banks. Few realized that a single model, scaled to billions and mirrored across the industry, was at the center of the storm. Inside the fund's headquarters, tension mounted. Meetings stretched late into the night. The founders insisted the models would stabilize once the panic passed. But the markets were no longer responding to theory. They were responding to fear, leverage, and the rapid unwinding of crowded trades. The perfect idea had entered its most dangerous phase. Every attempt to stabilize the situation risked accelerating the spiral. Every lever they pulled seemed to tighten the pressure instead of relieving it. The genius was still there, but so was the flaw. And for the first time, the world could feel the two colliding. The break came with a jolt, so severe it echoed through markets around the world. A sudden, unexpected move in a key asset, one the model had always treated as stable, triggered losses far larger than anyone inside the fund believed possible. Screens that once displayed neat, predictable patterns now showed violent swings. Spreads blew out. Correlation spiked. The model didn't just misfire, it detonated. Within minutes, the fund's carefully calibrated positions unraveled. Losses cascaded through portfolios built on leverage and precision. Margin calls hidden waves. Brokers demanded collateral the fund no longer had. What was once a masterpiece of mathematical balance now looked like a tower of glass collapsing under its own weight. The conflict reached full intensity as the founders faced the unthinkable. Their system, celebrated, studied, admired, had become a threat to global stability. The sheer size of the trades meant that each attempt to exit positions made the market convulse even harder. Copycat funds, trapped in similar trades, began liquidating as well, adding fuel to the fire. The strategy that once produced quiet, steady returns was now unleashing chaos. Panic spread across trading floors. Veteran investors watched as assets that had never moved together suddenly collapsed in synchrony. Phones rang nonstop. Rumors swirled. Was a major bank exposed? Were multiple funds failing at once? Had a hidden crisis finally come to light? Everyone searched for a trigger, but the truth was far more unsettling. The crisis wasn't caused by an external shock. It came from inside the system itself. Regulators noticed the fractures. Emergency calls were made. Officials demanded updates from banks, funds, and clearinghouses. They needed to know whether the damage was contained or whether the unwinding of one strategy threatened to cascade into a global market meltdown. The uncertainty ricocheted through every asset class, turning even safe havens into battlegrounds. Inside the fund, the emotional weight grew heavier with each passing hour. The founders debated whether to shut down positions entirely or fight to stabilize the portfolio, but each option carried disaster. Selling would accelerate losses. Holding would risk utter collapse. The tension between logic and survival tightened like a rope pulling in two directions. Meanwhile, markets reacted with raw intensity. Assets swung wildly as liquidity thinned. Traders spoke in clipped, urgent tones. Analysts tore through historical data, searching for precedents, and found none that matched the scale of what was unfolding. The messiness was too interconnected, too amplified, too fast. And at the heart of the storm, the founders realized a truth they had avoided for years. Their model wasn't built for a world where everyone followed the same playbook. It wasn't built for scale. It wasn't built for panic. It wasn't built for markets that could shift in minutes instead of days. The fatal flaw had fully surfaced. The genius idea that promised near perfection had created a system too fragile to survive the very conditions it helped shape. And now, with the world watching, the strategy teetered at the edge of total failure. Its fate hanging on the next move, the next headline, the next tick of the market. The collapse didn't arrive with a single dramatic moment. It unfolded through a series of quiet acknowledgments, calls to investors, emergency meetings with banks, internal decisions made in rooms heavy with silence. The fund that once symbolized mathematical perfection had reached the point of no return. The only option left was to unwind. The climax struck with a strange sense of inevitability. As the news broke, markets reacted instantly. Prices whipped for hours as the remaining positions were liquidated. What had begun as an intellectual triumph ended as a cautionary tale etched into financial history. Billions were lost, reputations shattered, and the legacy of a perfect strategy was reduced to a reminder that no model can fully capture the complexity of human-driven markets. But as the dust settled, a new understanding took shape. The strategy hadn't failed because it was flawed. It failed because the world around it changed. Assumptions that once held true had crumbled under the pressure of scale, imitation, and unprecedented volatility. What worked beautifully in theory unraveled under the weight of real-world behavior. where fear spreads faster than logic and leverage magnifies every crack. The resolution echoed through trading desks and classrooms alike. Models are tools, not truths. They can guide, but they cannot promise. Their beauty lies in structure, but their weakness lies in the unpredictability of the world they try to simplify. Markets on equations, their ecosystem shaped by emotion, speed, and the unseen connections between millions of decisions. In the years that followed, new strategies emerged, new formulas, new ideas that borrowed from the genius of the past, while trying to avoid its downfall. But the lesson remained unchanged. Every breakthrough carries risk, and every elegant solution hides a shadow. The fatal flaw isn't always in the model. Sometimes it's in the belief that a model can ever be perfect. So as investors reflected on the rise and fall of the strategy, one question lingered. Were they safer now, or simply waiting for the next perfect idea to reveal its own hidden weakness? Subscribe to join the journey.